Hello traders, welcome to Investoo.com's flash course on how to correctly position your stop losses. In this lesson, we are going to explain why it's not very wise to use a fixed pip stop loss on your trades. And there's going to be a lot of traders that are going to tell you that it's the best scenario to work with a fixed risk to reward scenario. And I agree, it's the best thing to do. I personally don't take trades unless I have at least a 1 to 2 risk to reward scenario. But that doesn't mean that I'm always going to be risking 20 pips to make 40 pips. What this means is that the setup that I'm looking at could yield twice of what I could risk on the trade. Now, first of all, we're going to use this US dollar Canadian dollar trade as an example, and I'm going to zoom in on this trade. Now let me just get rid of this rectangle. On this trade, as we already told you, we put our stop losses above the area of resistance. Why? Because if price were to move above our area of resistance, our trade idea would no longer be valid. And this area of resistance was 56 pips away from our entry, which means that our take profit of 139 pips, if I'm not mistaken, 136 pips yields a better on an almost 1 to 3 risk to reward ratio, which is excellent on the trade. Now let's imagine that first of all I'm going to show you where we took our position, and for that I'm going to show you our terminal, and you can see that the US dollar Canadian dollar sell position was taken on the 24th of May at around 15 hours on my MetaTrader 4 clock. Now I'm going to grab my crosshair tool and I'm going to show you exactly where we took that trade. So it's the 24th at 15 hours. So we took it around this candle, all right? Let me show you again. If you look at the bottom of my MetaTrader platform, we are on the candle that was forming at 15 hours on the clock of my terminal on the 24th of May. So when we broke with these lows, we took the short position, okay? Right here, this is our entry area. Now, let's imagine that I am one of those traders that likes to take fixed pip stop losses without regarding what the market is telling you or what the structure of price is. And let's assume that I like to take a 20 pip stop loss. So I'm going to go ahead and put a stop loss right about this level. 20 pip stop loss would be right here at the 31.53 level. So I'm going to grab my tool, my horizontal line, and it's the 31.53 level we said. So right about here. Now let me thicken out this chart for you. Why? Because we are going to look at a candle per candle basis. We took our entry, or we took this position right here when this candle, now let me just move this rectangle, okay, when this candle that you see right here broke with the lows. Now the entry really doesn't matter much, because what I want to show you is what would have happened after that. So I'm going to move again back down to the 50-minute chart. And as you can see, we are now on the 50-minute chart. Let me show you. US dollar, Canadian dollar, 50-minute. And what would have happened if I was one of those traders to take a fixed amount of pips on a stop loss? Well, we would have been filled on our short position, but price would have taken us out on a loss before moving down what is now 100 pip win. So if you look closely, by using a fixed amount of pips and disregarding what the market structure is, you are going to get stopped out on trades that are eventually going to go in your direction a lot of times. So that is going to make your win rate drop enormously, and that is going to affect your overall profitability while trading the financial markets. So never use a fixed amount of pips with